Some businesses are a lot easier to understand than others. Charlie and I don't like difficult problems.
Two legendary investors, Warren Buffett and Charlie Munger, flat out dislike popular companies that sponsor elite athletes, sell trendy apparel, and rack up billions in revenue from passionate fans? Of course not. They would adore owning part of any extraordinary business churning out huge cash flows from cult-like customer loyalty built on true value instead of mere hype. But despite Nike's jaw-dropping brand dominance and stellar track record in sports apparel, the Oracle of Omaha and his sage sidekick have never invested a penny into Nike stock. Why could that be? Does one of the most successful consumer companies in history somehow not need the approval of history's most brilliant capital allocators? In today's video, we will highlight 7 key reasons why 2 of the wisest financial minds avoid Nike stock and probably always will. Grab some popcorn and let's get started. Reason 1. Nike's global complexity defies the simple business doctrine. Buffett and Munger's first pillar is sticking to simple, predictable companies they can easily grasp. As the Oracle says, risk comes from not knowing what you're doing. Nike, with its sprawling international supply chain, fickle fashion trends, intense competition, and complex financials, is simply not simple enough for them. Contrast this to See's Candies, the quintessential simple business Berkshire has owned for decades. While Nike has performed excellently over time, trying to forecast earnings 5 to 10 years down the road involves substantial guesswork on consumer tastes and rivals' innovations. Buffett and Munger refuse to invest in businesses whose futures are opaque or require speculative forecasts. So Nike fails the simple business test that has guided these masters for decades. Reason 2. Nike's rich premium valuation repels the value-focused duo. Core to Buffett and Munger's philosophy is acquiring stocks trading substantially below intrinsic value to create a margin of safety. This buffer protects against unforeseen events while enhancing upside potential. But good luck finding many periods when Nike stock looks cheap by typical valuation yardsticks. Benjamin Graham's star pupils demand a bargain before investing. Unlike dogs of the Dow they salvage from the trash heap, Nike almost always exhibits a rich premium multiple reflecting predictable quality growth baked in. Without a sufficient valuation margin, Buffett and Munger won't entertain an investment regardless of superb brand equity or financial performance. Patiently awaiting a distressed price is key to their discipline. Reason 3. Nike lacks the true, enduring competitive advantage. A hallmark of all Buffett/Munger core holdings is a durable competitive advantage, insulating companies from rivals and sustaining profitability. Brand supremacy alone fails to qualify. Unlike an essential product protected by patents, Nike battles every day to keep athletes and sneakerheads loyal to its swoosh versus similar offerings from Adidas and Under Armour. Fickle consumer products rarely enjoy strong, lasting moats in the eyes of Warren and Charlie. Reason 4. Allegations of sweet shops and unethical labor practices. For executives obsessed with integrity, ethical breaches that jeopardize institutional reputation are cardinal sins demanding accountability. While Nike has come a long way from past violations, supply chain audits, and monitoring hardly scratch Buffett and Munger's standards for treating labor as cherished human capital rather than expendable input costs. They applaud Costco for flipping Wall Street's ethos towards caring for employees as prized assets. While no company is spotless, Nike's supper ethics record undoubtedly bears weight on these crusaders who believe integrity powers enduring prosperity. Their mentor, Ben Graham, insisted on examining qualitative factors like trust and goodwill, critical pillars conspicuously absent from Nike's heritage in their view. Corporate character matters immensely even if consumers glance past scandals. Reason 5. Susceptibility to shifting consumer tastes. Legendary retailers from Sears to Blockbuster have disintegrated virtually overnight by misunderstanding changes in popular demand. Fickle consumer preference poses substantial medium-term earnings risk to apparel brands, especially those without Costco's sticky membership subscriptions. Buffett and Munger fret over rising generations losing brand affinity with symbols of their parents' generation. They have witnessed fortune fade for iconic brands, failing to resonate with youth. While Nike feels invincible now, its future hinges precariously on style trends shrouded in uncertainty. Reason 6. Excessive marketing spend failing the value for money ethos. Our Omaha oracles detest brands charging eye-watering premiums for commodities by redirecting billions toward marketing rather than superior functionality or materials. In their minds, Nike commits corporate sin by doling out massive sponsorship contracts and advertising dollars to manufacture desire for overpriced shoes instead of delivering genuine value. This offensive imbalance outrages their frugal sensibilities nurtured growing up during the Great Depression. While charismatic marketing contains merit, value-focused stewards cannot stomach seeing customers overpay for products deliberately tuned more towards status signaling than performance-enhancing innovation, giving hard-earned money genuine return. Recent 7 sports branded ownership could needlessly distract focus. The billionaire buddies crave absolute clarity of purpose, preserving time for what counts, prudently allocating capital into productive assets, and extraordinary leaders capable of boosting future cash flows. Owning a flashy consumer brand, trading on pop culture relevancy risks, seductively diverting energy into trend forecasting and celebrity-endorsed marketing campaigns devoid of underlying business value. But it's still fascinating to see how Buffett and Munger analyze businesses, even iconic brands like Nike, to determine what meets their investing criteria and what falls short. So, what do you think? Does Nike seem too risky of an investment, even with its brand dominance? Would you invest in Nike today or still stay away? Let me know your thoughts in the comments. Don't forget to like and subscribe for more interesting videos like this.